I've been watching this game, this whole financial charade, for a very long time. And I've learned to trust my eyes. When I see a building burn down and I notice one guy walking away with a gasoline can and a matchbook, I don't need a committee to tell me what probably happened. What you saw in silver this past Friday, that wasn't a market moving, that was a market being moved. I was going to spend my day doing things that actually make money, but I couldn't stop thinking about the sheer, breathtaking audacity of it. The story they're selling you is a children's book, a simple tale of cause and effect. The reality is a surgical strike, and you deserve to understand the anatomy of it. Because if you don't, your money will always be someone else's opportunity. Let me walk you through what actually happened, because the narrative is a trap designed for lazy minds. On Thursday, silver hits an all-time high, $120 an ounce. Historic, unprecedented. The chatter is everywhere. This is it, the breakout, the new paradigm. By Friday afternoon, it's at $78, a $42 collapse, 35% of its value evaporated. Now, I want you to think about that for a second. We're told this cataclysm was triggered by the nomination of a new Fed chairman, Kevin Warsh. A hawk, they say. Let me be clear. That is not a reason. That is an excuse. That is the cover story handed to the newspapers so they have something to print that fits neatly between ads for luxury watches and ETF commercials. Does a personnel announcement, a nomination, not even a confirmation, justify the single worst day for silver in over 4 decades? Does it explain a $3 trillion evaporation in gold market value in a single session? Half the annual economic output of Germany gone between your morning coffee and your dinner reservation? Of course it doesn't. It's absurd on its face, but it's a tidy story. It's clean. It doesn't require asking uncomfortable questions. It doesn't force you to look at the mechanics. And that's exactly the point. I know what you're thinking. You're thinking markets are volatile. Sentiment shifts. These things happen. That's what they want you to think. That's the mental cage they build for you. The cage of things just happen. So you never look for the hand. Let me show you the hand. Let me break down for you the 5 precise coordinated actions that turned a market into a massacre. This is not conspiracy. This is mechanics. Pay attention. First, JP Morgan, the largest commercial short in the silver market, closed its massive short position. They covered their bets. And they didn't do it as the market was falling. They didn't do it in the panic. They did it at what appears to be the exact bottom. The precision is laughable. The kind of timing that retail traders spend their entire lives chasing, that algorithms are built to find, and they nailed it perfectly, not near the bottom. The bottom. That's not luck. That's a predator who knows exactly when the prey is exhausted. Second, the London Metal Exchange, one of the 2 most critical trading hubs for silver in the world, experienced a systems issue. It went offline at the precise moment the New York sell-off was accelerating. Coincidence, I'm sure. A glitch. Technology fails. Except third, HSBC, the second largest short holder on that very London exchange, also had systems issues at the same time. 2 major institutions, both with significant short positions, both go technologically blind during the most violent crash in a generation. What are the odds? Don't answer that. The odds don't matter. The effect does. It meant liquidity vanished from a key venue. It meant Asian and European players were locked out. It concentrated the panic into one pipeline. Fourth, the CME group in Chicago, where silver futures actually trade, executed their weapon. They aggressively raised margin requirements. Now, let me explain this slowly, because this is the trigger. This is how you force people to sell. When you trade futures, you don't pay for the whole contract. You put down a fraction, a deposit called margin. It's leverage. At $120 an ounce, a standard contract controls $600,000 worth of silver. You might only need $60,000 to control it. That's 10-to-1 leverage. Beautiful on the way up, deadly on the way down. The CME has the power at any time to say that deposit is no longer enough. They can raise the requirement. And on Friday they did. They hiked it substantially. So picture the retail trader, the small fund, the guy who pushed his chips to the center of the table at $120. He's fully leveraged. His $60,000 is all in. Suddenly the CME tells him he needs to post another $30,000 immediately. He doesn't have it. What's his only option? He has to sell his position to generate cash. He is forced to sell, and here's the dirty secret. The exchange knows exactly where these margin pressure points are. They have the data. They can see every stop-loss order, every account's leverage ratio. It's a map. If you wanted to trigger a cascade of forced selling, you'd have a roadmap showing you exactly which price levels to hit. And fifth, they launched this entire operation when the Asian markets, the biggest physical buyers of silver in the world, were closed for the weekend, asleep in the dark, unable to react, unable to buy, unable to provide any stabilizing bid. Only then did the news hit the wires, the catalyst, the Fed chair story. The match lit after the gasoline was already poured. So you tell me, you look at those 5 points, the perfect cover, the convenient outages, the margin hike, the timing against Asia, and you tell me if this looks like an organic market movement. Or does it look like a playbook, a financial blitzkrieg designed for one outcome, to liquidate the leveraged long and allow the entrenched short to cover at a fire sale price? This isn't speculation. This is observation. I'm just connecting dots that are laid out in the open. They're counting on you not to bend down and look. Now let's talk about history, because this is where the arrogance becomes clear. They think you have no memory. They think you're a goldfish, swimming in a bowl, forgetting the last lap every 10 seconds. This is not the first time. This is the fourth. The playbook is worn, dog-eared, but it works every single time because the audience is always new. Let me walk you through the greatest hits of silver suppression. The Hunt brothers, 2 Texas billionaires, actually tried to corner the physical silver market. They bought and bought, drove the price to $50. And how did the establishment break them? The exchanges changed the rules mid-game. They implemented Rule 7, which essentially banned buying silver. You could only sell, think about the sheer gall of that. A marketplace founded on the principle of bringing buyer and seller together simply outlawed one side of the trade. What happens when you can only sell? The price collapses. The Hunts were bankrupted. The message was sent. This market is not for outsiders. 2011, post-financial crisis, people are terrified of banks, of paper money. They flood into silver as a safe haven. It runs from $18 to $49. And what happens? The CME raises margin requirements not once, but 5 times in 2 weeks. Each hike forces more leveraged players to sell. Each sale drives the price lower, triggering more margin calls. It's a self-fulfilling doom loop. Silver is cut in half. The fear trade is neutered. Order is restored. December 2025, just 2 months ago, silver hits a then all-time high of $84. What happens? The CME raises margins twice during the thin, low-volume holiday trading between Christmas and New Year's, when everyone is with family, when markets are skeletal. It takes very little to move the price. Silver drops 13% in a day, a warning shot, and now January 2026. Silver at $120. A new shocking high. The playbook is reopened. Margin hikes, systems issues, perfectly timed news. The only thing that changes is the cover story. In 2011, it was the fear trade is over. In December, it was year-end profit-taking. This time, it's a hawkish Fed chair. The mechanism is identical. The outcome is identical. They are not being clever. They are being repetitive. They rely on the collective amnesia of the investing public. They rely on you not seeing the pattern, because if you saw the pattern, you'd see the manipulation, and you might get angry, or worse, you might get prepared. Here's what they absolutely do not want you to understand, and this is the core of it all. This crash created nothing. It solved nothing. On Thursday, the world needed a certain amount of silver to build solar panels, electric vehicles, semiconductors, and medical devices. On Friday, after the crash, the world needed the exact same amount. The industrial demand did not change. The physical shortage did not change. We are in the 5th consecutive year of a structural supply deficit. Millions more ounces are consumed than are pulled from the ground every single year. The crash didn't magically discover new mines. It didn't make ore grades richer. It didn't slow down the global push for electrification. All it did was change a number on a screen. It changed the paper price. And in doing so, it transferred wealth from the hands of the leveraged many to the vaults of the powerful few. You see, there are 2 silver markets. There is the physical market, real bars, real coins, metal you can hold. It moves slowly based on actual shipments, actual industrial orders, actual supply chains. Then there is the paper market, futures, options, ETFs. This is where the price is set. This is a derivatives casino, a world of promises and leverage. The paper market is where this crash happened. And while the paper price is being bludgeoned down to $78, something astonishing happened in the physical market. The premium to get actual deliverable metal in Shanghai hit a record high. Some paid 40, 50, even more above the paper price. In Dubai, same story. People were desperate for real silver, paying massive premiums. While the screen flashed a number everyone knew was a lie, the two markets divorced. The paper market screamed, "Sell." The physical market whispered, "There isn't enough." Which one do you think is telling the truth? So let's talk about the real plan, because there is one. It's not hidden. It's in the open. It's a reset, a reclamation of territory. The plan is to use the paper market, which they control through rules, leverage, and speed, to discipline the physical market, which they do not control. Their goal is to scare you, to bankrupt the over-leveraged speculator, to make an example out of anyone who thinks they can play in this arena without permission, to send a message so loud and so violent that the next time silver starts to run, the retail crowd remembers Friday and hesitates. They are enforcing a ceiling, a psychological barrier. But here's the flaw in their plan, the crack in the dam, the physical deficit. You cannot manipulate geology. You cannot algorithm your way into a new silver mine. It takes a decade and billions of dollars to bring a major mine online. The grades are falling. The easy silver is gone. Meanwhile, demand is not a speculative fantasy. It's a physical reality. Every new solar panel mandate, every EV rolling off a line, every AI data center coming online, it's a direct order for silver. The green energy transition isn't a stock story. It's a metals order slip. And the order slip says, more silver. The plan can create paper panics, but it cannot print physical metal. That is their weakness. That is the tension that will eventually break something. Now, I want to address the excuses I know are forming in your head. I can hear them. But the Fed does matter. Of course it does, but not like this. Not with this violence. This was a pretext. But markets overshoot. They do. But 35% in a day on no fundamental news is not an overshoot. It's an engineered collapse. Maybe it was just a bunch of coincidences. Listen to yourself. You are constructing a fairy tale to avoid an uncomfortable truth. When you see 5 highly improbable events all aligned perfectly to produce a specific beneficial outcome for the most powerful players in the room, you are not looking at chaos. You're looking at design. Stop giving them the benefit of the doubt. They have never given it to you. Let me give you another piece of context they hope you missed. That same Friday, a major newswire pushed a story claiming the U.S. government was ending support for strategic metal stockpiling. It was a bombshell. The algorithms picked it up and sold harder. Human traders panicked. Hours later, the U.S. Energy Department issued a statement. They didn't say the report was mistaken. They said it was deliberately misleading. Their words, deliberately misleading. A false story pushed at the exact moment the market was most vulnerable to maximize panic, another coincidence. Added to the pile. The point is, the environment was weaponized. Information, technology, rules all turned against the crowd. This is the game. You have to understand the game. The game is not buy low, sell high. The game is create liquidity events, panic the herd, harvest their assets at distressed prices, and then provide a simple, palatable narrative for the regulators and the newspapers. Wash, rinse, repeat. The players in the Rolls Royces are not better stock pickers. They are better game masters. They design the board, they write the rules, and they change them when they're losing. Your job is to recognize you are not a player in their game. You are a resource. You are the liquidity. You are the exit for their bad bets. The moment you see that clearly, you can stop being the prey. So what do? I'm not here to tell you to buy silver. I'm not here to tell you to sell. I'm here to tell you how to think. Because if you don't change your thinking, you will lose this game every single time. Let me give you the principles, the rules for surviving in a rigged arena. First, know what you own. Are you owning a paper claim, an ETF, a futures contract, a mining stock, or are you owning a physical thing? There is a world of difference. Paper comes with counterparty risk, margin risk, and rule change risk. Physical metal comes with storage risk. That's it. Nobody can margin call a bar of silver and you're safe. The crash on Friday was a paper crash. The physical metal didn't evaporate. The people holding paper were slaughtered. The people holding metal just watched a number go down. Their asset was unchanged. Second, position size is everything. More important than being right. If you are leveraged, you have given them the weapon to use against you. You have handed them the detonator to your own account. Your position should be sized so that a 35% drop, a 50% drop is uncomfortable but not catastrophic. It should be sized so that you cannot be forced to sell. Forced selling is where they make their money. If they can't force you out, you take their weapon away. The dentists in Ohio who got wiped out weren't necessarily wrong about silver. They were wrong about how much they bought. Leverage turns a market fluctuation into a personal disaster. Third, understand time horizons. The paper market thinks in milliseconds. The Wall Street narrative thinks in headlines. You need to think in years, in cycles. This crash is a blip on a decade chart. If your thesis is based on a 5-year industrial deficit, does a one-day panic, however violent, invalidate it? No. It tests your conviction. The plan is to make you myopic, to make you react to daily terror. Your defense is to zoom out. The weighing machine of fundamentals always overcomes the voting machine of sentiment in the long run. But you have to be around in the long run to see it. Fourth, embrace the truth that legal and fair are not synonyms. What happened was almost certainly legal. Exchanges have the right to raise margins. Market makers have the right to close positions. News wires can publish rumors. It's all within the rules. The rules are written by the winners. Your job is not to cry foul. Your job is to study the rule book, see how it's tilted, and play accordingly. Don't expect a fair fight. Prepare for an unfair one, and you might just survive. Fifth, use their arrogance against them. They are repetitive. They use the same playbook. 1980, 2011, 2025, 2026. It's the same sequence. This means their actions are predictable. The next time silver makes a powerful run to new highs, you will know what to look for. You will watch for the margin hike announcements. You will watch for technical issues at key exchanges. You will see the scary headline hit the wires. And instead of panicking, you will recognize the play. You might even use their engineered panic as an opportunity because you'll know the fundamentals haven't changed. You'll know the physical shortage is still there. You'll see the violence for what it is, a tantrum by those losing control, not a change in reality. Finally, internalize this. The disconnection between paper and physical is the crack in their armor. When people in Shanghai are paying a 50% premium for real metal, while the CME price crashes, the system is telling you it's broken. It's saying the paper price is a fiction. This divergence cannot last forever. Either the paper price must rocket up to meet physical reality, or the physical market will completely abandon the paper price as a benchmark. Both outcomes are catastrophic for their plan. This is their dilemma. They can manipulate a derivative, but they cannot manipulate a rock. Let me close this by telling you what's really at stake here. It's bigger than one bad day in silver. It's about trust. It's about the credibility of the entire price discovery mechanism. If people stop believing the price on the screen represents reality, the entire architecture of modern finance, built on derivatives and paper claims, starts to crumble. Friday was a demonstration of power, but it was also an admission of weakness. They had to use this much force because the upward pressure from physical reality was so strong. They are fighting a tide. And you can't fight a tide forever. My message to you is not one of hopelessness. It's the opposite. It's a message of clarity. Once you see the game, you are no longer a pawn. You can choose not to play their version. You can choose to own the physical asset, size your positions for survival, extend your time horizon, and wait. You can let the leveraged speculators and the algorithms battle it out in the paper arena while you sit on the solid ground of tangible reality. The plan is to make you reactive, emotional, and scared. Your plan should be to be patient, logical, and prepared. They want you to believe finance is magic. It's not. It's mechanics. It's pressure points, leverage, and incentives. This crash was a masterclass in applied pressure. Now you've seen the class. You've seen the professor's technique. The question is, have you learned? Or will you walk out of the room and wait for the next lesson, which will cost you even more? This is not about getting rich quick on silver. This is about understanding how wealth is transferred from the uninformed to the informed, from the emotional to the calm, from the leverage to the patient. Last Friday, a massive transfer occurred. It didn't go to the smart investors. It went to the powerful ones who control the machinery. Your path forward is to build a strategy that doesn't depend on their machinery. That depends on reality. So do your own research. Look at the supply deficit numbers yourself. Look at the solar installation forecasts. Look at the EV production schedules. Then look at the mining production forecasts. Do the math. The math doesn't lie. After you've done that, decide. But whatever you decide, go in with your eyes open. Know that the screen price is a suggestion, not a truth. Know that the rules can and will be changed to protect the house. And know that your single greatest advantage is the one thing they cannot manipulate: your time horizon and your patience. If you want more of this, not tips, not recommendations, but the blunt mechanical truth about how money really moves, then you belong here. This is a community for people who are tired of fairy tales and are ready to study the blueprint of the casino. If that's you, subscribe, turn on the notifications, but only if you can handle the truth without flinching. The road to clarity is paved with uncomfortable facts. I'll be here sharing them. The rest is up to you.